Hello, everyone. Welcome to Trading a Smaller Account. My name is Barb Armstrong. I am a coach with Charles Schwab and delighted that you are joining us here today. So, as per usual in this class, we have an absolutely jam-packed class. We're going to do a little bit of trade management. And we're going to spend most of the class placing new trades. And I thought it would be kind of cool to do a bullish trade, a neutral trade, and then a bearish trade. But my friends, it seems that many of the things I looked at seem to be more bullish than bearish. So we're going to skew more to neutral and bullish today than bearish. So happy Friday. We've got a full house today. Glad to see so many of you here. And I want to thank those of you who are so participatory in the chat. So to Willie and Rob and Connie and Kevin and Chris and Josh and Scott tuning in from Maui. And, we've got lots of people who are fans of baseball, of course, following the Dodgers or the Mariners, the Blue Jays. So lots going on. So good morning to Frank and Breakout Bob and Billabury, who was actually the first one into the chat this morning. So glad you are all here. So without further ado, if you are not following Mr. Ben Watson and I in the chat, you are missing out. And you should be following us on X also. So my handle at Barb Armstrong CS, Ben's is at Ben Watson CS. So be there, be square. And just before we get going, know that in this class, we do a lot of options trades because this is this is a small account class. And so we use options hopefully to our advantage. But know that options carry a high level of risk and aren't suitable for all investors. You have to apply for option trading privileges with Schwab and not all will qualify. And just know that we use the Paper Money software application on the Thinkorswim desktop platform. There are some nuances and some differences between those. One we're going to talk about today, and that is that a short option will never be assigned early in Paper Money. That can happen in a live account. So as some of you may know, I'm coming to you from my hometown of North Bay, Ontario, which is about 250 miles north of Toronto. People asked me if it was cold up here. And today it's kind of a cool rainy day, but it has been beautiful and sunny all week long here. Temperatures in the 70s. So, yes, a lot of people think in Canada it's 10 months of winter and 2 months of tough sledding. Not necessarily. So, yes. And somebody else asked if we watch baseball. The Toronto Blue Jays. I lived in Toronto for a long time, and I would love to see nothing more than the Blue Jays tee it off against my son-in-law's favorite team, which is the LA Dodgers. So, and both of them are doing pretty well in their series. Both of them play tonight. So, if you're a baseball fan, I know where you will be tonight, probably watching a game somewhere. All right. So this account, we're going to do a very quick market overview. James Boyd did an amazing job at the market open this morning. There is a Trader Talks every morning. And so for an in-depth market overview, please refer to the Trader Talks series. But this is where we're going to focus on our new example trades and managing our existing trades. We started at the beginning of the year. Actually, this year we started with 25,000. Our max position size is 5,000. And even if this is 20,000, 25,000, you'd say, excuse me, 20% of your account in one asset. And we have chosen to do that because of the size of the account. If you had $1 million account, and I do have an example account with $1 million in it, our max position size in that is might be 50,000, which would be, 5% of the account value. Or you might even want to make it 25,000, 2.5% of the account value. So these, don't take this as the IG of that means I should be willing to have position sizes that represent 20% of my account. It's because of our account size that we have chosen these. And our max risk per trade is 500. Okay, and our focus is on the short to intermediate term time frame. All right, so let's get out to the platform. And that's just, if there's anyone here that is new, please, type a greeting into the chat so that we can welcome you. We link arms here every Monday and Friday at high noon Eastern. And we are figuring this stuff out together. Okay, so when we look at the S&P 500, in the last week or so, we hit a new all-time high on this index. It has been uptrending really since April 7th, and it's now flirting with the 30-day moving average, but pretty bullish overall, right? Like Chicken Little is still snoozing. And the NDX, our NASDAQ, which is our tech-heavy index, we're looking at the same kind of thing, up almost 17%, 16.68% year to date, and, just kind of hugging along, marching up that hill, hugging that 30-day moving average. Okay, how about our Dow? So the Dow 30, this is 30 stocks, and unlike the NASDAQ and the S&P, these are based on the price of the stock. But again, recently hitting an all-time high and within, a stone's throw of it, continuing to move to the upside, up 8.5% year to date. Our small caps, the Russell, it too hit a new all-time high on Wednesday of this week and is now, sitting, we've got a hammer pattern at the 30-day moving average, which has been acting as support since, when? Since about the beginning of May. So that's looking pretty bullish too. And then our volatility index, and you'll see, I'm going to post something on X later today about the VIX, just kind of 6 things you may not have known. So stay tuned and watch for that. Like I said, I'll be posting that on X. But, we've seen a lot of action. They say that the VIX is lower if it's below 20, and it has spent a lot of time since since May in that below 20 range, where it seemed to be, there's more confidence in the market. The market tends to be uptrending and more stable. When we're above 30, some might use the expression all hell breaking loose, but, there's certainly a lot more uncertainty and volatility. All right. Okay. So there we go. Now, let's start with a trade that we have some management to do on, and that is Intel. And then we'll go and place a new trade. So whenever you see INTC, I interpret that as better have a look. Okay. So because it means that you have an option on this that is expiring, and in fact, it expires today. So we have the 37 call, and this is in the money. So if we do nothing, and if this trades above like 37.01 or above, unless there has been some kind of special condition put in, this will be assigned or we would be called out. And we would have our max gain, and we're cool with having our max gain. But if, when I first looked at this, it was 40 some cents. But could we look at this and maybe roll it out from October to November? So if we come and we look at the chart for INTC, we can see that here is our buy rate. I think we put it on this day, and it's trading just above $37. And so could we look at this and say, hey, if I come out to say $40, and we no longer have this one on, I think we took this off, so I'm going to just edit this. Could we come out to 40 and do another covered call for November? I think it's the 21st. And would there be enough premium in it for it to be worth our while? So if we come to the trade tab, or we can come to the monitor tab actually, and just highlight this and say we want to create actually a rolling order. So this means we're buying back the one that expires today, the October 17th. And what it will do is roll it out to the next closest time. We may say, well, we're interested in rolling it out to November. So we get a credit of $3.11, which on a $37 stock, is not nothing. Like that's almost 10% of what we paid when we got into this trade. But what if we could roll it up to 40? Would we still get a credit? Well, we'd still get $1.94. And then there's the possibility of making an extra $3 because if it expires in the money today, and it's currently trading at 37.49, so it could easily expire in the money, then we'd be called out and we'd have made, our max gain on this. And we're close to it now. We're within 20 cents, which is around $320 is what we'd end up making. But if we roll it out, we could potentially make an extra 500, because an extra $3 on the price of the stock, if in fact it went up to 40, and then we'd receive the extra premium. So if we come here and we say, okay, if we could make $196 on this credit by selling the 40 call and buying back the 37, and then make that, we're interested in doing that. Okay. Yeah, and so Art is asking the question, why not let it expire, take the money and run? And we can do that. That is a very valid, that's a valid strategy also. Because when we placed this trade, we said, hey, if we are called out, what will we be? We will be happy campers. And why would we be happy campers? Well, because we agreed when we had this conversation with ourselves. So if I add $22 to this, if we could make $320 on an investment of $33.78, which was what we paid when we got in. So if we look at this, $320 divided by $33.78, that's about a 9.4% return. Now we'd have to take off the 36 cents we paid because we bought a protective put on this. So, and might we buy another protective put? We could. We could do it at that same 30. So if we came out here and, why might we do a protective put? We might just do it to cover us over earnings, and earnings is October 23rd. So we could do a protective add to this. So first triggers sequential. We could say we just want to come out to just past October 23rd. So October 24th, is it the 23rd or the 30th? It's October 23rd. So if we come out to the 24th and we did the 30 strike again, so let's give us 20. Oh. 28. Well, here, if we did the 31 strike, it would cost us 23 cents. And you might say, well, do we really want it to be that high? We might come to this one and say, here, our low here was 34.69. So let's go, let's make it 33. Let's make it the 33. So we're looking to protect. So that would cost us 54 cents. But we're protecting this opportunity if the stock were to tank on earnings, to perhaps make this extra 500. And so if we say, okay, we're willing to do that, then we're going to come here and we're going to click on the buy, and we're looking to buy a put for protection. So this is a married put. Okay. So yes, some would call this a collar. Yeah. Because we're selling a covered call at the top and we're buying a protective put at the bottom. Okay. So, and we're going to put this in our buy right covered call bucket because this is where it started. And so that's a reminder to us that this is how we started with this. And we're rolling the first call to November for additional premium and a higher strike. Now we can see that ourselves, but if you wanted to put a note in from ourselves to ourselves, Wiley likes the prenup conversation, doesn't he? Yeah, I say, this is not a long-term love affair. This is a dating strategy when we do a buy right. Okay, so we're putting that in, and so, we're filled. We got our $1.97 there. Okay, so let's go and look at a new trade now. Okay. I thought maybe we could look at an iron condor. Anybody interested in looking at an iron condor? Some of you may be saying, like, what on earth is an iron condor? We don't tend to do a lot of those in this class. And part of the reason is the market has been so darn bullish. Like, you want to pick a strategy that's congruent with what's going on in the market overall. And the market's been hitting all-time highs, but CRM is down 27% year to date. So it is kind of marching to its own drummer, and that is not the drum beat of the NASDAQ or the S&P. And, so it was kind of like rolling down the hill a bit, and then it hit this 226 level, and it's hit it a few times, hasn't it? So let me just bring up my drawing tool here. So it's kind of hit this a few times, like once, twice, 3 times, like 4 times, like, and then it's kind of hung out kind of in this neighborhood. And then when it comes up and bonks its head on the ceiling, it's done that a few times too, as recently as yesterday. And so the idea of selling an iron condor, to those of you for whom this may be new, is our expectation is that it's going to stay above this 232-ish level, and that it's also likely to stay below this 257-ish level. And so we're going to sell a short put vertical, which is a bullish to neutral strategy, which is profitable if it stays above our strike. And then we're going to sell a short call vertical, which is kind of a bearish to neutral strategy, which is profitable if it stays below the strike. Okay. And so I call this a credit spread sandwich, and we have got the perfect iron condor sandwich as long as this thing stays and continues to just, move, lollygag about, as I like to say, in between these two strikes for the next 20 to 50 days, depending on where our expiration date is. And I like to kind of migrate closer to this 20 days. And why might a trader do that? Well, a trader might do that because time decay is going to have a bigger effect faster than it is if we go out 50 days. But what's the downside is that if it squeezes out to the downside or out to the upside, we have less time to recover. Okay, and we're also going to get less premium typically if we're out 20 days than if we're out 50 days. So let's go out and have a look. Are there any questions on this strategy? Okay, so we're going to look first. We want our strikes on this to be above 257-ish and at or below that 231-ish. So maybe could we look at at a 260 strike and a 230 strike. Okay, so that's the idea. This absolute low here was 226.48, but it closed that day at 231. So, okay, so we're going to, and I like to look at each side on its own because I want each side to kind of pull its own weight, so to speak. So if I come and look at this and say, okay, if I come out and if we go out 21 days, does this trade more than 1 million shares a day? Yep. Do we have lots of contracts here? Yes. This is open interest. So we've got lots of contracts. So we were saying, well, could we look at kind of that 260 type level? Well, we've got contracts. We've got a 35-cent bid-ask spread. That's in that 10% range. So if we say, okay, we want to sell a vertical, we get 97 cents. So 97 cents is just under 25%. But for a trade, we're going to be in for, okay, let me write this down, 97 cents. Now, if we do the other side, 225, 220, or could we even look at 230? Well, 230 has a delta of 22. And what the probability, so we'd get 94 cents on that. So we're getting about an equal amount on both sides if we did the 230 and the 225. So if I make this would be, sorry, I kind of like to see it on the chart too. And you may or may not. Like some people don't ever look at charts, they just look at probabilities. Um, and other people really like to look at the charts. And then this is 260 would be our strikes at the top end. And so if we say, I could see this has been trading in this range for the last, like since the beginning of August, since August 1st. So it's been doing this for 2.5 months. I could see it doing this for another 3 weeks. So if we think that that's a reasonable expectation using our superlative technical analysis here, we're going to come out and say, okay. And so if we want to put this in all as one trade, we're going to say we want to sell an iron condor at 260 and 265, and then the bottom strikes we want to be 230 on the put side and 225. So we'd receive a credit of 203. So if we look at that and we say, okay, so if I could make $2 and then how much am I risking? Well, we're risking 5. And this is why a lot of people think these are such a delicious strategy. So we're risking 5 minus what we were paid to get in. So it's 2 divided by 3 is what we're risking. So our potential return on risk is 67%. Now, what we're going to do is we're going to take our single order, first trigger sequence, and say, hey, if we've got 80% of our max gain, we're going to just buy this back and take our risk off the table. So to do that, we're going to create an opposite order, and we're going to make it a limit order and say, hey, when this whole thing is worth 40 cents, we'd like to buy it back. Now, is it possible for us to get out a bit at a time? Like if it comes up and hits resistance, we might want to close out the short put leg. So we could do that. But if we're just lollygagging about, or we're out walking the dog or visiting family or doing whatever, and we're not paying close attention, it could hit our target. And the next time we open up our screen, we can see that, we've hit our target. So we're going to put this in the iron condor category. Okay. Any questions on that? All right. So there's our first, and this is really a neutral trade. Would you like to see another example? Another iron condor example? Okay, let's look at this one. Also starts with the letter C. Not that they're sponsoring today's presentation, but if we look at CrowdStrike, now, when we looked at CRM, it's been on the struggle bus. CrowdStrike is the exact opposite. It's up 38% year to date. And this one is also not sitting in the middle of the pack, right? It's bouncing off a support level. So what we might choose to do with this one is go out a little further, say go out to November, and let's look at the short put vertical side. And if we say, well, we want to be below 470, it's currently trading at 483. So could we come out to November? Now, what's the disadvantage here? The disadvantage is these are $10 wide. So if we do this 470, we've got lots of contracts here. It's bouncing off a support. So this might be a good time to get in, but we'd get 375. So what does that mean? It means we're risking 625. And we don't want excuse me, we don't we don't want to risk that kind of money. And so we might say, okay, well, what if I come up and go up higher than normal because it's bouncing off a support level? So instead of, if I look at this, what was the recent high? 517.41. So if instead of going to 520, and I mean, it hit 517 here, hit 517 again here, do we do sell the 520 or do we try and go even a little bit higher to maybe the 530? Well, let's see what we could get. So if we come down here, and we're coming out now 35 days, so we want a higher return. If we come out to the 530, do we still have lots of volume? Yes. We have a probability of it being in the money, which is what this probability I stands for, probability in the money, of 22%, 22.8, 60-cent bid-ask spread on a $10 option. So if we get $2 for that, that helps bring it into our snack bracket as from a risk perspective. Yeah, now, Chris makes a really good point. So Chris is saying, like, hey, Barb, like, why don't you look at November 14th? And I did, actually. But here's the problem. Look at the bid-ask spreads on these. Like, they're really wide, and we don't have nearly as much volume. So it's a possibility, but you know, when we look at this 500 strike, it's 1340 and 1785. So the bid-ask spreads are just too wide, because the $5 wide spread would have been kind of perfect for us, wouldn't it? And so we're going to look at doing this a second iron condor. We're going to give it more room on the upside because this is a more bullish stock, right? And we're looking at selling an iron condor. So 530 and 540, only on the downside, we want it to be 470 and 460. 470. $460. So we get 562. So that's over 100% return on our risk, because we're risking 562. You know, we're risking $10 minus 562. So we're risking 438. And so we might say, well, if we can get that kind of return, and if we're more bullish on this stock than bearish, maybe we want to give it even a little more room. Okay, so maybe we want to go 540, you know, more room on the upside, 550. What? We'd still get 530 over $5? Man. Okay. Because that's still over 100% return, right? Because we're risking 10 minus 537. So we're risking 473 to potentially make 537. 537 divided by 473. 73? 63. That's a potential return of 116%. And so if we say, okay, that those strikes look good, 470 and 460, and then 540 and 550. First trigger sequence, right click. When are we going to buy it back? When we've got 80% of our max gain. Say that's 537. I'm going to use my calculator. It is Friday. 537 times 0.2. So $1.07. When this is worth $1.07, we want to buy it back. That would give us 80% of our max gain. We're going to make that good till canceled. Iron Condor. Now, and this one, as a rule of thumb, we're in this one 35 days. So we wanted to get at least a 35% return. But, it's looking more robust than that. And so we're going to come to our chart and we're going to put here, this is 470. Iron Condor, 470, 460. Okay, show it on the right. So that on Monday, like if we want to see how this is doing, we can look at it, edit properties. We're going to just repurpose this and make it 540. Iron Condor, oops. Uh, 540, 550, and it's November 21. So now we know when it expires. So as long as it stays, like we're giving it lots of room even to the upside. Where it currently it's been trading in this tighter range. So if it breaks out to the upside, we're still pretty good. Okay. So somebody is saying, Trade and Grow is saying, the majority of the gains are coming from the short put spreads. Should we just do that? And I love that question because that's exactly what I was thinking. Let's just do the short put. As we got over we got more from the short put than we did from the short call vertical. But even if we got 3 something and we were getting around 350, we're risking over 600. And we don't want to risk over $600. Our price, our max risk per trade is 500 to maybe 550 because this account has grown over the course of the year. But so we may up how much we're willing to risk a little bit, but we don't want to risk over 600. That's the reason that we felt we couldn't just, I would call that legging in. So to add the short put vertical now, so this is another way you can trade this, is to say, I'm going to do the short put vertical now, and then if it comes up and rolls over, then I add the short call vertical. But, and if it keeps on going, then my short put vertical is a big success. Either way, I'm a happy camper. But we can't really do that because this is a $10 wide spread, and we needed to go to the $10 wide to get the liquidity. So there's all these things that help influence how we decide whether or not we're trading something, what to trade, and how we're trading it. And we were more bullish, and that's why we put these strikes out further, because we were getting such a great premium. And we had to give up very little to go from 530 to 540. So we said, hey, that's, $10 worth of extra buffer for about 20 cents. Somebody's asking if these filled. So yes, our CrowdStrike filled. That was $10 wide. It filled for 545. Our Iron Condor on CRM filled for 209. That was $5 wide. And then we rolled the covered call on Intel from 37 expiring today to 40 expiring in November. And then we added that protective put. Yeah, so we've done a lot. Okay, so let's go and do another trade management little thing. So this one is, trade's gone wrong. And if you're thinking obviously we're brilliant, and we've had a lot of successful trades, and we have, but here's one, whenever you see a short put vertical and it says in the money, be afraid, be very afraid, because what does that mean? It means it's expiring this week. And today is Friday, y'all. So this was at 475. So our strikes were at 585 and 580. We were expecting MasterCard to stay above 585. And it's now trading at 560. Now, I would have suggested we buy it back because first thing this morning, we could have bought it back for 475. But now it's like it's saying the mark is 577. The most we can lose on this is $500, less what we paid to get in. So we could put this in and say, hey, if you can close it out for $5, we'll take it. But otherwise, after the market closes, both of these will be exercised and we will have our max loss, which is $325, which is $5 less the $1.75 we were paid. So that I was going to show us, how to fill it out. And sometimes, you can end up with a paper money, what we call a paper money fill, on something, when you're trying to get in and you have to go in. So we could say, we want to create a closing order. We'd like to close this out for $5 because that would be our max loss. But if that doesn't fill, and it's saying here the mid price is 578, if it doesn't fill, we will take our max loss on that. Yeah. And we should have looked at this one Monday and likely closed it out. And at that time, we might not have taken our max loss, even though it was going through both strikes. Okay. Then the other one I wanted to we're just going to have a little peek. Lulu, this was a bearish trade that we put on. And so this thing's been rolling down the hill like pretty much all year long. Like, it's down 57% year to date. And the NASDAQ is up, what, 18? 17. And this SPX, is up it's up 12 and a half. So Lulu is again marching to its own drummer and, not a happy drummer, as they would say. Like it is below the 10-day, the 30-day, and the 100. And so our swing target we put here just above this previous low of 159.25, it's at 160. And so we've seen, other rays of light. Sometimes it's made a little rally, but, today it's moving up. But, we had kind of this potentially bullish day here, and then it moved down. So we're going to wait and we'll look at this again on Monday. But currently, and this is where it's important to realize that what the market giveth, the market can taketh away. We're still up 8% on this. Actually, you know what? I'll let everybody vote and we'll do whatever you guys think is best. So do we wait, and with the expectation it might go down again? Or are we concerned about the market wiping out? We were up by 120 something when the market, or 130 something when the market opened today. The market has taken 2/3 of our profit away in one day. So let me just come down and we'll add a little poll here and you guys can all vote. So I'm going to start this poll and it's for Lulu. Take the money. Take the money and run, or be patient. And like, I'm not saying that there is a right answer. Somebody's saying close it now, because it could go up for 5 or 6 days. And what's our, we have another 35 days, but time decay is going to be ticking away also. Okay, so I have got to start wrapping up, but if you wanted to look at some other bullish opportunities, and we looked more at neutral opportunities today, and could we look at American Express, which just had good news on earnings and is moving again to the upside, up 15% year to date, breaking above this previous potential, ceiling or resistance level. Like this stock is up 6% today. Could we look at NVIDIA, sitting nicely, like a bird on a wire on the 30-day moving average. Yesterday, we had this Harami pattern, which doesn't require confirmation Today, a bullish engulfing pattern. So could you do a swing trade from 182 to 195? Well, we may look at that Monday, or could we do a short put vertical? I mean, there's lots of things we could do. You know, could we look at a Walmart? You know, broke out previous ceiling. Could it become a new floor? You know, it broke out with gusto here. Today we have this, you know, 1-day pullback, and then could this be establishing a new support level because we have this Harami pattern happening here. So there's lots to look at. I just actually reviewed what we did. You know, so we did 2 iron condors, 1 on CrowdStrike, 1 on CRM. We rolled a buy right covered call. And so if you didn't place the last one, you may have chosen to kind of play along by just placing a new trade with that 40 call, you know, in your paper money. And then we protected that because we've got earnings coming up next Thursday, you know, with a protective put. So, and then we looked at a short put vertical that did not go our way and looked at how we might manage that. So there is a survey in the chat. You know, the verdict on our long call on Lulu is to exit that trade. And so I will go in and exit that. And we did have a target and exit, so we're just going to cancel that whole group so that we can go in and just kind of take our money on Lulu. So on Lulu, we're just going to come down here and say, hey, we made a little bit. Beats a poke in the eye with a sharp stick, as I like to say. We're going to exit that. Okay, so there is a survey in the chat. So here's my ask. If you fill it out, there's just 2 questions. 1 was I hated it, 10 was I loved it, and then there's everything in between. And so, and there's also the ability to put comments in. So if there's something you'd like to see me cover in an upcoming class, let me know. I promise if you fill it out that I'll read each and every comment, and so will the management team. So that's 1. 2, if you hit the like button, it's your chance to do a favor for a random stranger whom you may never meet without leaving your chair. So hit the like button. It also lets Ben and I know that you found this to be valuable. It moves this up in the YouTube algorithm so more people can find this content. Follow Ben and I in the Land of X, Ben Watson CS, Barb Armstrong CS. And if you haven't hit the subscribe button, it's access to another free resource. Don't hesitate. Hit the subscribe button. You'll be glad you did. And that's a wrap. So get out and hug someone you love, my friends. Yeah, have a really great weekend. And we'll see you back here at high noon on Monday. Coming up next, lots of great content still to come. So I hope you stick around. Take care, everyone. Bye for now.